Good day and welcome to this webinar on making PPM a competitive advantage. I am Richard Sonnenblick, the CEO and founder of Enrich, and I'm delighted to be able to talk to you today about this important topic. At Enrich, we have worked with companies for the last 2 decades in their innovation processes and portfolio management processes to help them make the best of every euro and leverage the collective wisdom of the entire company in every single R&D decision that gets made. All of the companies that you see on the screen in front of you are current clients using either Enrich Viewport or the Enrich Analytics platform to make critical R&D decisions, refine their portfolio, and communicate portfolio risks and opportunities to management and the rest of the company. What makes Enrich a little different is our awareness and understanding of the entire portfolio ecosystem. And that ecosystem begins with the data consumers, the executive team, and the device, therapeutic area, or product line leadership. And they're looking for the latest information about every opportunity, and they want to be able to drill down into that information very quickly. The portfolio analysts are tasked with providing that information, but of course they're not the ones that are creating it in all but the smallest companies. It's being created by financial, commercial, project, business development, and clinical teams. And the challenge is ensuring that the portfolio analysts are able to synthesize that information and provide it to the data consumers in a way that it can be understood without being a bottleneck to providing that information. So let's take a look at the essential activities of portfolio management that are involved in this ecosystem. It begins with end-to-end business models. And those business models need to look not just at the resources required, right? Not just at the FTEs, but also at the value and the opportunity presented with each initiative, so that there's an understanding and an agreement that these are the right initiatives to actually pursue. Now that end-to-end is critical. If you're simply looking at a net present value or simply looking at a revenue estimate, you can argue about it all day and not get anywhere. But if you have an end-to-end model that allows you to go beyond just the number and dig down into the product profile that leads to your market share estimate or the unmet need that leads to your market size, then you have something substantive that you can actually discuss. And you can agree to disagree, or you can reach consensus around what each opportunity represents. Now, the transparency there means that you're able to understand exactly who's made what changes and what assumptions to each of the business models in your portfolio. If you understand who's changed what and when it's occurred, then you're able to have an understanding of how each of your initiatives has evolved over time in terms of its value story, its cost, and its schedule. With this in place, you should be able to allow the data consumers to explore from the portfolio to an individual project and drill down, come back up to the portfolio, look at another project and drill down into that project, and then go to the product view. So go to the lifecycle management view where you're actually understanding your line extensions versus your lead indications and so forth. In this way, you have some agility around the views you show, and the views themselves can keep up with the interests of the executives, those data consumers. In many cases, we've found that this allows the portfolio team to stop building 100-slide, 150-slide PowerPoint decks as backup in anticipation of every question the data consumers might ask, and distill it down to a deck of maybe 20 or 25 slides. This can then be augmented by real-time use of the Enrich Analytics platform or Enrich Viewport to review the specifics of the portfolio. The third essential activity is scenario planning, and this might include prioritization, optimization, and also looking at how the portfolio fits with your strategic goals and how the portfolio makes best use of available resources. So whereas in the real-time exploration, we were looking either at the portfolio as a whole or each project by itself, with scenario planning here in the prioritization, we're looking at each opportunity in the larger or broader context of the whole portfolio and understanding how the whole is hopefully greater than the sum of the parts. Prioritization is the most straightforward type of planning that's done here, but in many cases you'll be looking at buy up and buy down scenarios on a project by project or compound by compound basis, or perhaps entirely different investment plans that emphasize different regions, different therapeutic areas or technology platforms, or an entirely different orientation for the portfolio. The key here is to be able to not only compare those scenarios, but easily store and archive them so that 6 months from now or 6 weeks from now, it's easy to pull those scenarios back up and recall what your hard work showed you about those scenarios at the time, and then update those scenarios quickly and easily, and then make them relevant for today to do another scenario planning exercise without starting from step one again. Now, all of this, in terms of these essential activities, really hinges upon your ability to make confident decisions. And so this fourth quadrant here includes making those decisions and recording them, and then being able to communicate them to management or to your peers. So this communication is around showing the scenarios that represent your base case or your momentum strategy, and then comparing them to the plan of action you're advocating for. So you can help people understand both where you're headed today and where you could be headed with a slightly different allocation of resources. Now, we know that once you've made those decisions, they're not set in stone for perpetuity. So it's quite possible that the clinical readouts that follow or the competitive landscape shifts that occur may cause you to revisit some of these decisions. And any tools you use need to be able to help you revisit those decisions and see if, in light of this new information, the current investment allocation still makes sense. Now that we've looked at these essential activities, I think it's clear to see how, with support in each of these activities and the ability to do all these activities in a confident way, you can really create a competitive advantage with portfolio management. We're going to look now at some of the excuses that we've heard from folks in the industry about why portfolio management just isn't something that they can do. I think the most common thing we hear is that there isn't enough data for us in our company to do portfolio management yet. So there's no sense in even trying. And if there is data, we've heard that, well, the data is not really up to date. And we also, as a consequence of this, don't trust that data. We're not sure that it really reflects accurately the projects and the opportunities, the costs and the risks of each of the assets in our portfolio. Even worse, perhaps, our management doesn't trust that data. And as a result of that, management's ignoring the reports we compile, and we're not even sure what the value add that portfolio management is providing to the organization at this time. So this is what the portfolio team says. Let's look at what the executives have to say. What's ironic here is that while we all talk about big data executives are starving for information about the portfolio. So we have this dichotomy where on one hand, the portfolio team feels they're not being listened to and the data isn't ready. And the executives are hungry for this information, but they're distrustful of the information that's provided. So in order to make portfolio management a best practice, I'd like to propose a progressive approach to collecting and using information. The first critical aspect of this is to just start with what you have. Perform as much analysis as you can with your current data set, and let that drive the discussion about the next data to compile. So once you've shown the portfolio as you're able to represent it today, then that's going to create an appetite among the executive team for more information. And let them decide what information should now be collected across the portfolio. That's critical because you don't want to ask all at once for too much new information from your project teams. Your project teams have a day job, and they are completely consumed with getting their projects through trials, through the life cycle of development. And if you begin asking them for too much new data, I guarantee you either that data will come in late or be of questionable quality or both. So if they know that the executives are asking for this data, they are much more likely to devote time and resources to a careful accounting of the cost, risk, and opportunity associated with each of their assets. So let's look at the different categories of information you need for portfolio management. And as we build up this slide, keep in mind that if there's one thing I would like you to take away from this webinar today, it's that you do not need all of this information to perform portfolio management. And in fact, in the next 40 minutes or so, we are going to look at bits and pieces of the information you need. And I hope you'll see, with even a small amount of information about your assets in your portfolio, you can begin to build portfolio visualizations and draw conclusions about the value and balance and strategic appropriateness of your portfolio. So we begin with this orange box, for lack of a better word, beginner, although there's no judgment associated with that word. And this represents really just a naming scheme, an inventory of active projects, essentially structured information about the project classification, such as the phase or the brand or the product line. So some very simple information, also perhaps with a little bit of milestone, start and end information for the different initiatives. With that in place, you can move to a more sophisticated set of information that talk about constraints, helping people understand what's it going to cost us? What's the cost in the current budget cycle? What's the cost to implementation? What's the cost in terms of the specific skills that are needed to get this project to market? With the intermediate piece in place, you can begin to think about value, not just cost. Now, value begins, for many companies, with scores rather than hard financial criteria. You may have scores that show strategic fit or market risk, market attractiveness, market maturity, technology attractiveness, technology risk, and so forth. And then you move into the more financial criteria. So within each of these sets, the orange, the green, and the yellow, keep in mind that if you have even one blue box completed to some extent, you're ready to perform portfolio management. There's no need to have all of this information together in order to do portfolio management. And in fact, it's better if you start just with what you have, as we talked about in the last slide. So let's start with that beginner piece, creating a structured inventory. A structured inventory begins with a consistent naming scheme. Now, given the velocity of information coming in about your portfolio in the run-up to a portfolio review, it's essential that you have a systematic way of naming your projects that everyone has agreed upon. If people are throwing spreadsheets around via email or via SharePoint, and you're unsure which one represents a given project, a given initiative, let alone a given scenario for a given initiative, you're likely to very quickly lose track of essential new information about assets in your portfolio. It's important, too, to define clearly the scope of what's meant by your portfolio. Does it include assets in every phase of development? Those that have already gone to market? Those that need additional research after going to market? What we might call phase 4 studies in life sciences or drug development? Do we look at those assets that are currently under consideration with business development deals and in licensing from other companies? All of these questions need to be answered so that when someone looks at the portfolio, they understand where the fence has been drawn. Now, project classifications speak to how you discern what type of project you have. This might be in drug development, a therapeutic area, otherwise a division, might be a phase in the life cycle, might be a technology platform or a mechanism of action. And there will be start and end dates for each of these assets and maybe for given phases within the life cycle for each of these assets. So with this information, you can now assess redundancy in your portfolio. You can see where there are projects that are very similar, but maybe being completed or undertaken by different groups. You can see where there are gaps in your portfolio vis-a-vis certain strategic goals or spending allocations that were intended. And you can see where you might have too many projects addressing a given technology platform or a given market. So let's take a look at how you might build some of these views in the Enrich Analytics platform. So what we're going to look at here is a simple bubble chart. But rather than look at your typical risk return, where you would look, for example, at probability of launch, maybe versus ENPV, what we're going to do is look at that therapeutic area classification versus a phase classification. And here we're able to see right away that we have a lack or a paucity of programs in dermatology, and we have just a few programs in our early, what we call preclinical phase of development. So right away, this information lets us know that we might have an imbalance across our therapeutic areas. Now keep in mind, we're not looking at cost information yet, or value, so we're going to color these, we're going to size these all equivalent. And let's say we color these by maybe a strategic fit. And we can go ahead and just put a nice color scheme on there. So right here, we have some information about our portfolio, just given classifications, that's going to tell us something about where we're placing our bets. We don't yet know how much money we're spending, but we do have a sense of where we have focused our development teams, our product teams. Now let's move to the intermediate stage of data collection. So portfolio management is about trade-offs, and those trade-offs exist because we don't have enough funds or enough people to do everything we want to do. And in point of fact, if your portfolio is able to fund everything that you can consider undertaking, you may not have a portfolio management problem. You could start with a simple estimate of what is the cost of each program in the current budget cycle, in the current year or the current quarter. How much is it going to cost us? Because we know how much we can spend, roughly speaking, in the current budget cycle. You could then become a little more sophisticated with an estimate over time of the amount it would cost to implement your opportunities all the way to launch, all the way to either getting them to market, or if they are manufacturing improvements or yield improvements or other internally related opportunities, just getting them to completion. So having that cost profile over time is going to be a more sophisticated way to begin to trade off what you're looking at. Keep in mind, though, that as you do that, you're going to need to consider discounting. You're going to need to consider inflation or constant dollars. And for both of these, the current budget cycle and cost implementation, you need to think about, are these euros or dollars fully loaded? Do they include G&A, or are they just representative of the project itself in terms of allocated costs? So let's take a look within the Enrich Analytics platform, what we might do here. We'll remove value, and we'll just look at the current year cost. We could certainly sort by the current year cost, or we could sort by cost to launch, or we could bring in the cumulative current year cost here and begin to set up the projects that we intend to fund for this particular budget cycle. And we could see how the cumulative cost allows us to see, with that project and all of those above that have been funded, as indicated by the checkboxes here, how much it's going to cost us to fund those selected projects. And here, without any understanding yet of value, we have a simple way to see, have we undertaken enough projects to completely spend our budget? And if we want to look at this in terms of the specific launch timing or the phase of each of these opportunities, we can do that here. Now, of course, people are not interchangeable, nor are manufacturing facilities or other facilities associated with development of our assets. And so we can begin to think about the people and skills that are needed. And as we do that, we need to separate strategic capacity planning from traditional project management. In traditional project management, you're going to think a lot about your detailed project plan for each of your assets. In strategic capacity planning, we talk about not obsessing over your work breakdown structure. This means looking at maybe the study level, or at worst, the activity level. We're not trying to build a comprehensive Gantt chart that includes every sub-activity or task across every asset. We're interested in tracking staff classes just to the first level of bottlenecks and no further. So we want to understand maybe, a dozen, or at most 75 or so different skill sets or roles. And we might be looking at their utilization on a monthly basis, but better on a quarterly basis. We're looking directionally at the number of staff we'll need across a book of work, across a set of initiatives, not on an hourly or daily or even weekly basis. We're doing this on a monthly or quarterly basis. And that's because those details that you will be keeping in your project management system become quicksand when you perform strategic capacity planning. If you get bogged down in the details of those individual fifth-level work breakdown structure tasks when you're trying to do strategic capacity planning, you are actually creating or instilling a false sense of precision. And here's why. We all know that in most of our project management offices, we have a large number, we've seen even 50% or more of activities that are later delayed. And so unless you plan on keeping your work breakdown structure assiduously up to date with all of those delays, any kind of super detailed capacity planning simply won't work. We recommend that the actual assignments are worked out by your program leads weekly or monthly, and that's done at a level below strategic capacity planning. So that's not done in your strategic capacity planning tool. Strategic capacity planning, as I said, is more directional than it is precise, and you want to think about your key high-level levers, and those levers are really adding contractors, adding full-time staff, which sometimes takes 6 to 9 months to even procure a single staff member, and perhaps outsourcing or partnering for some activities. So let's take a look at what that might look like within the Enrich Analytics platform here. So what we're bringing up here is a staff analysis, and we'll look at this for the current month and 12 months beyond that. On the right side of the screen, excuse me, we have a heat map that shows us for a given set of roles, where do we have shortfalls in orange, where do we have surpluses in blue. And we see, for example, a shortfall in the medical writer role. So we can click into the medical writer role and get an understanding of which projects, as indicated on the key event map for the book of work on the left side of the screen, contribute the lion's share of resource requirements to the medical writer role. We can see that there's a committed chunk at the bottom here across the time horizon, but then beyond that we see Crefacil is really the lion's share, and that's what's contributing to taking us over the top of our available staff, as indicated by this orange line. So it's easy for us in the tool to simply decommission Crefacil. And in doing so, we now have no further shortfall in the medical writer role as well as other roles here. Unfortunately, this is probably untenable because Crefacil is an important project. So let's go ahead and add back in the committed activities within Crefacil. And then let's go ahead and also add in some of the phase 3 activities that are upcoming soonest, and some of the phase 4 activities. And we can see now we're coming to the limit of our staffing. And let's add in just a couple more non-phase activities that we know are going to be critical. Now, once we've added in a few of these, we see that we've now gone over our overall allocation. So we can go ahead and delay one or more of these activities a few months. And as a result, take some of the pressure off this particular role. Now we have a decision receipt that allows us to see what have we removed and what have we delayed. And we can take this information back to our project management office and begin to talk about how this book of work can be cleared. So directionally, this is the way strategic capacity planning can work effectively. And we've seen this work well in a number of firms. The key is not to do it in your project management system where you'll drown in the details very quickly. So now let's talk about operational views. In addition to this kind of strategic capacity planning, we can look at roadmap views, flag charts, and brick charts. So we'll take a quick tour of some of these now. Now, to build a roadmap in the Enrich Analytics platform requires just a few clicks. We already have a launch date column here. We'll just extend that out to make it a little larger, emphasize the Gantt chart a little bit more. And now we'll group by therapeutic area. In this case, it's the division or proxy for divisions. And it's easy for us to see now how projects complement one another in a roadmap sense or a life cycle planning sense within each of the therapeutic areas. If we wanted to look at this across a different dimension, such as molecule size, we could bring in molecule size here and now group by molecule size. And now we've built a roadmap around molecule size instead. That's useful when we're looking at the life cycle view. But if we're looking at what are the upcoming events across specific phase or milestone transitions, there are other ways to do that. A flag chart is a really effective way. And this is something we've developed in tandem with our clients that satisfies a need we haven't seen satisfied by project management or portfolio management systems that exist out there. So as I've been speaking, I've built up an event view that shows us for, and let's move this to April 2019, for the next several quarters, what are the transitions that are occurring in our portfolio? Let's actually color these by the specific transitions, and let's spread this out just a little bit here. Now, we can put more information on here if we wanted to put in the milestone date. And let's clear this one out. Now we have a sense of what are the upcoming phase transitions, and we see very easily, very quickly, that there are a series of phase 2 transitions coming up at the beginning of July. This may or may not be an issue. The key is that it's easy to see it in this view. It's actually harder to see that here in the roadmap view unless you speak Gantt chart innately. So these flag charts can be invaluable for understanding what's coming up on the horizon. Brick charts provide you something like a periodic table of the elements. Excuse me. And we're going to look here at just a simple brick chart, and we're going to color this by strategic fit. And let's actually take those projects that are of critical financial status or behind and move them above the line here. So now you can see a pipeline view. Let's go ahead and put a little bit more information in here. And we'll put the launch date in here as well. Great. So now we have a view that helps us understand our pipeline in terms of balance. And we're also looking in terms of financial status, above the line is critical or behind, and we're looking in terms of strategic fit. We could add another dimension here, such as therapeutic area, and put those across the rows. So we'll split by none. And now you can see we have the therapeutic areas represented in rows and the phases represented by columns. And in all of these views, it's important to remember that if you want more information on a given initiative, that's always just one click away. So I can click, for example, on Avniman, pull up information on its development cost profile, its revenue, and even get information on its product profile, or the entire profit and loss statement, or even unstructured information like the label. All right, let's continue by moving to value. So value begins, for most companies, not with hard financial criteria, but with some sort of scoring model. And we found generally, scoring models are used most commonly by those groups working on early stage initiatives. In drug development, this means discovery level, pre-first-in-human compound assessment. And in this research forum, looking at some key question areas like those you see here can be very valuable. So scoring your projects as a function of size of unmet need, severity of unmet need, product profile uniqueness, looking at competitive intensity, looking at clinical or CMC developability, and translatability and safety are all key question areas. So a lot of folks, before working with us, end up with a scoring model result that looks sort of like this scatter plot in the top right corner. By this I mean you have a tight knot, or what you might call a hairball, of projects that don't seem to differentiate themselves from each other. To avoid this, we recommend not having too many questions, so there's something for everyone. Wording your questions carefully so that it's clear what's being asked and unambiguous, and you can defend your answers. No grab bag questions, so have your questions assess one dimension at a time. And no redundant questions. Don't overly weight a particular type of question by having multiple questions asking the essentially same thing. And then for each question, have a concrete set of examples across your anchors. So let's look at what this means. Questions in each category should be mutually exclusive yet collectively exhaustive, and they should be simple to understand. In terms of weights and scales for the questions, we get a lot of questions about this because there's a lot of scoring model and multi-attribute theory out there. But we do advocate making all questions initially and all categories equally weighted. Nonlinear scales and weights have their place, but starting simple and again going for transparency is more important. Defining questions. Here's a sample question for you, looking at competitive impact. You can see several things. One, we have more than just the name of the question. We have a little bit of background, supporting information. And then for some of the response values, 5, 3, and 1 in this case, we have anchors. Those clue in the respondent to what a 5 means versus a 3 versus a 1. Once you've scored your questions, it's important to do a postmortem and understand, are some questions correlated with each other in terms of responses across your set of assets? Are some questions very poor in terms of the variability of the scores that were used? In these cases, those questions are probably not helping to differentiate your portfolio. And then finally, using sensitivity analysis to assess the impact of different weighting schemes can be very useful. So if you want to weight one category or one question a little bit more, a little bit less as a function of what your executive team finds important, and then look at the change in ranking for your assets, you'll get a sense of whether those changes in importance actually have an impact in the change in ranking. So let's look at a couple sample questions. Here's one on internal technology gap. And you can see that we have anchors not just for 1, 3, and 5, but because this is on a 1 to 10 scale, we have anchors for 5 different points across the score range. And in all cases here, a higher score is more attractive. So if we're talking about risk, high risk would be 1, low risk would be 10, for example. Here's another question, viability of external partners. You can see here there's an extensive amount of information that's provided in terms of evidence and reasons, the factors to consider in assessing the risk of partnerships, so that everyone is thinking about the same risk factors as they assess the initiative in question. One question we get asked quite frequently is, do we sum scores around total attractiveness? Do we take all of our question categories, such as risk or cost or value, and just sum them together so we have one value? Now, it is seductive to have one value in its simplicity. However, cost is not always bad. Risk is not always bad. Innovation is not always good. And complexity is not always bad. What's important here is not to distill these into one score, but rather to look at trade-offs between complex projects and simple projects, and to understand that you probably want a balance of high-risk and low-risk projects, and very innovative and less innovative projects. And so keeping these dimensions separate is probably in your best interests. Okay, now let's start talking about hard financial metrics. With hard financial metrics, you're going to be looking at something as simple as market size and stopping there, or moving to a sense of competitive intensity with market size to give you a revenue estimate, maybe a peak revenue estimate or revenue over time. And then if you begin to bring in your costs of goods sold and your R&D costs, you can begin to look at profit. And eventually you can begin to look at cash flow. So where you fall on this continuum is completely up to you and your team. There's no one right metric here. NPV is not going to work for everyone. We really see a continuum of metrics, from addressable market size to the revenue metrics to cash flow metrics. And what you choose is really a function of the strategic goals and the way that you measure the overall alignment with strategic goals in your portfolio. The current project phase for each initiative, you may be looking at market size for your early phase projects and a hard financial metric for your later phase projects. And the current project duration, if it's a short-term project, you probably don't need to do too much analysis. The same for, is there a lot of money or a small amount of money on the line? And how complex is the technology, and what are the risks involved? Market uncertainties are an issue here. And taken together, you can see that there is no one right answer. As you perform your financial valuations, it is critical that there's comparability across those valuations. I'm not going to go into these in detail, just to say that different terminal values or different time horizons and so forth will cause you not to be able to make apples to apples comparisons about value, cost, and risk across your set of assets. All right, now let's talk a little about prioritization. I think the easiest way to define it is to say we're sorting by desirability. And that desirability is some sort of goodness, some sort of value. That value might be a strategic fit score, could be a simple project score, aggregating multiple dimensions, or it could be something like a peak revenue or a net present value. But we're probably not going to do this just looking at goodness. We probably want to look at bang for the buck, bang for the euro. A ratio of total value over remaining cost, not just the cost in the current budget cycle. So this might be the score over cost to launch, or the ENPV or another cash flow metric over cost to launch. So let's take a look at how this might work in practice. We'll build an efficient frontier, and we'll look at this with respect to ENPV and current year cost. And our value metric, our numerator, will be ENPV, and our cost metric will be cost to launch. And maybe we'll color these by our therapeutic area. So now we have a sense of our highest value project down here and our lowest value project up here in terms of bang for the buck. And so it's tempting to draw a line here at 100 million and say, if we have a 100 million budget, let's fund these 5 projects here because they represent our most productive in terms of bang for the buck projects across our cost to launch ENPV metric. And let's forego all the projects to the right of the 100 million line. But the problem there is that we're not picking just the highest value projects. We're trying to pick the best set or collection of projects. And while prioritization is going to rank those projects by desirability, it's not thinking about other strategic criteria. It's not thinking about which therapeutic areas are most strategic. It's not thinking about a balance of revenue, short-term to long-term, and so forth. So we need to think about value and balance all at the same time. How do we do that? Well, we need to think about targets and buckets. And targets might be specific criteria that we want to meet. And that might be revenue or revenue growth, or the number of launches, the number of product introductions, the number of new product introductions versus incremental product introductions, and so forth. Or it may simply be the R&D spend that we want to allocate. But that in a vacuum isn't enough. We want to think about where those things are occurring. So is the revenue by division, and is there an allocation of how much revenue we hope to accrue within each division or each region, or the launches are by technology platform, the R&D spend is by innovation level, and so forth. So with a target and a bucket in mind and multiple combinations, we have a set of objectives. And now we can think about how to balance this value-based view with a more holistic view that thinks about multiple competing criteria. So we have that same frontier here on the right, and we're able to see which projects have been queued up for funding now. They're all orange. And I'm going to very simply, as an example, unfund all of those projects to the right of 200 million and fund all of those projects to the left of 200 million. Now in doing that, you can see our current year cost is 196 million, and we have a total value of 5.2 billion. And our cost to launch over the time horizon is going to be around 700 million. But what's interesting here is if we hover over those projects we haven't funded in immunology, we can see we've defunded our entire immunology portfolio. And if we look here in the different phases of development, we have defunded our entire early stage phase 1 and preclinical portfolios. We've got all our phase 3 compounds in there and our more productive phase 2 compounds. But because we've removed our phase 1 and preclin, we're not meeting our revenue target, this green line here, in the later years of our time horizon. So let's close this chart and let's bring phase back into the table. Now we're going to sort by our bang for the buck productivity ratio, and we're going to group by phase, and we're going to bring back in some of the higher productivity projects within those early phases. As we do that, you can see we've lit up some of these projects in orange, further right on the frontier. We've added $79 million to the current year cost. And we've brought in a few of our immunology projects and some of our phase 1 and preclinical projects. And you can see we've come closer to meeting our longer term revenue guide. So in this way, we can look at trade-offs for a given portfolio and see what it will take to meet certain strategic goals and see what it will take to properly balance our spending across phases, across therapeutic areas, or across other dimensions. And so bringing in any number of dimensions into a view like this is possible. You just need to select the layout you want to build and then drag and drop the specific views that you need into that layout. And then you can perform the kind of analysis we've just done. So we get a lot of discussions and questions around optimization versus prioritization. And there's no one rule for when to use optimization, but there are guidelines. If you have multiple buy-up and buy-down scenarios for each project, optimization can be more useful than prioritization because that efficient frontier doesn't accommodate buy-up and buy-down scenarios for a single asset very effectively. If there are dependencies in your portfolio between lead and follow-on indications, or product line technology development and product line extensions and follow-on launches, that's also difficult to do with prioritization. If you have wide disparities in affordability, so you have some very small projects and some very large projects, then prioritization may not allow you to simply draw a line and feel that you're getting the best combination of projects in the funded portfolio. And if you have projects at different stages of development, different innovation levels, different divisions, different technology platforms, and you want to provide spending guidelines across those, proportional allocations or minimum allowable allocations, optimization can do that far more readily than prioritization. Another important point here is optimization is not an answer in itself, but it's a way of creating compelling combinations of funded projects that you can then fine-tune, make politically palatable, and show to your executives, not with a justification of this is optimized, but a justification of look how this portfolio meets our strategic goals in a novel way that we're not able to do today. So I wanted to talk a little about variance analysis. Recall that fourth quadrant in our critical activities really homes in on that important understanding of what's changed in your portfolio. And when I think of what's changed, I thought of this record from David Bowie, but then I realized that David Bowie himself was really a study in variance analysis. So we think about all of the different looks that David Bowie had over the decades, and that's a great justification for why it's important to understand how things have evolved over time. To think about one David Bowie style, musical or visual, isn't to understand who David Bowie really was. So let's look at some different ways to perform variance analysis here, and we're going to compare our portfolio to one from about a year and a half ago, a 2017 Q3 portfolio. And right away, as we look at the portfolio here, you can see we have red and green bars, not just gray bars, across current year cost, ENPV, and cost to launch. This is immediately showing us not only the current ENPV, but where the ENPV is lower than it was for a given project at an earlier time period, essentially back in 2017. We can also look in terms of a waterfall view at something like ENPV. And let's look at this by therapeutic area. And let's add some totals here. And so now we can see that in 2017, we were dealing with a 4.2 billion value portfolio. Now we're dealing with an $8.3 billion value portfolio. What's changed? There's been a few drops in the immunology portfolio, and then a reduction in value for one or more projects in endocrine. But we've had increases in the following therapeutic areas, and we've added some CNS compounds to the portfolio. So in this way, we get a sense of exactly what's changed for ENPV, or for that matter, for current year cost, or for cost to launch. We can also just as easily here drill down, say, into endocrine, and understand what's changed specifically here. So we can click on the costs and revenue and get a sense of how has the revenue changed since that portfolio from 2017. And we can break this down on a project-by-project basis as well. And we can see that the lion's share of the increase in revenue is from eaglogen. All right. I wanted to talk about just one more area, which is scenario planning. And understanding that change is hard for people, and organizations are made of people, so change is hard for organizations. And the key to catalyzing change in an organization is giving people a discomfort associated with where we're currently headed, showing everyone quite clearly that the current trajectory is not a desired one for the company. The challenge with scenario planning is to show first where we're heading is not appropriate, and then to paint a different picture of where we could head. And one of the challenges with scenario planning is there are multiple types of scenario planning. Scenario planning differs by, most importantly, time horizon. And the time horizon then guides the orientation, whether it's tactical, operational, or strategic, the types of uncertainties you're going to consider, and the types of options you have available to you, and the scope that you're considering those options within. A short-term time horizon is going to be very tactical, and you might look at just delaying an initiative or even activities within an initiative, whereas a long-term time horizon over decades is going to look at post-peak oil, or a life expectancy of 50% higher than we have today. And we're going to be thinking about a societal level, or at the very least a company level. And so the key to effectively talking and performing scenario planning is to first agree on a time horizon for the scenario planning exercise that you need to perform. Now, we find that most scenario planning within portfolio management teams is done in the medium-term time horizon. Project management does scenario planning in the short-term time horizon. So medium-term, we might be looking at canceling a product line, a regional expansion is put on hold or created, or a technology platform is created. So we're dealing with, say, at the division or the company level. Those scenario planning examples may be something like a buy up and a buy down scenario for one asset or one initiative. And by buy up or buy down, we mean accelerated or decelerated development that costs us a little bit more money or a little bit less money than we're currently spending in our base case. Or different portfolio investment plans where we're looking at entirely different focus in terms of the therapeutic areas or the divisions that we fund. So very quickly, we'll just look at a simple scenario comparison here. And the scenario comparison begins with a bubble chart. But these bubbles represent a set of 3 portfolios, not a set of 3 projects. And if I hover over the current project's portfolio, I then see in the 2 charts below the expected revenue for that same portfolio vis-a-vis the other portfolios, and then the blue-gray wedge that represents the target revenue, and in the lowest chart represents the budget that we have through 2023. So we can then compare these portfolios, but also importantly, we can adjust the composition of these portfolios in real time and then come back up and see how that changes our trade-off space in terms of revenue, development cost, or any other dimensions that we choose to bring in. Moreover, we can have not just one initiative here, but multiple scenarios for each initiative, where we look at those buy up and buy down scenarios and change the membership into these investment plans where some are using our accelerated portfolio or initiative views, and some are using maybe the base case or the deferred views. I hope you've enjoyed this tour of best practices and making PPM a competitive advantage. I wanted to end by just talking about how the tools that we offer can be used within your organization. Viewport is our stripped down analytics platform that allows you to do all of the reporting you've seen today, as well as scenario analysis and drill downs. And the Enrich Analytics platform, or EAP, is the tool that allows you to do more enterprise-focused data collection, project valuation, project financial assessment, and capacity planning, in addition to all the visualizations. Now, the good news is that Viewport is something that we can turn on for you within 90 minutes. It takes literally an hour and a half for us to sit down with you, show you how to configure Viewport, and in less than 2 hours, you'll be looking at your portfolio online. With the Enrich Analytics platform, there's a bit more to do in terms of configuring your financials and configuring some of the valuation capabilities. So it's a 1 to 3 week startup. We'd love to talk with you about how we can bring Viewport or the Enrich Analytics platform to your organization to help you make PPM a competitive advantage. Thank you so much for your time today. We look forward to talking about your portfolio challenges in the near future.